Series. Money tips helping you to create wealth. Number 1. Set up automatic savings deductions monthly. Every month, the money that you save should be deducted from your salary and go into special savings accounts that you can't easily access. Don't dip into these savings as you benefit from compound interest. I'll explain this to you in another slide. Try to increase the amount you save regularly. More savings, more compound interest. Smart people save and save at good interest rates. Compound interest is basically interest on the money that you earn, and that interest gets added to your capital, and then you earn more interest on that money. This next slide explains clearly how that concept works. Study it, understand it, and apply it. Reduce unnecessary spending. The more you waste, the less you save. The less you save, the worse off you are. You should be saving or investing as much as you can in assets that create earnings for you. People waste a lot of money on eating out, so stop doing that. Cut out junk food because it increases inflammation in the body and drains the wallet. It's utterly delicious and soothing, only it isn't necessarily healthy to eat that way. Don't go into overdraft. It causes overdraft fees that waste money. Look for other ways to reduce unnecessary spending. 3. Reduce credit card debt. Credit card debt attracts high interest. When you buy on credit, interest charges are high and you're wasting money. Pay the credit card debt back as fast as possible to reduce the interest you pay, and don't use credit cards unnecessarily. 4. Don't co-sign for debt. If you co-sign for debt and the other party can't afford to pay, it will ruin your credit record. So don't countersign for debt. Tip 5. Buy used. Buy used. Just because you have the money to spend doesn't mean you have to spend it on new and fancy things. Buying new cars, for example, is expensive and unnecessary. As soon as you drive the car off the shop floor, it's lost value. Buying new is a waste of money, so rather buy second-hand and don't worry about how fancy the car you drive is. None of that matters. Smart, wealthy people don't drive fancy, expensive cars. Max out your retirement. Maxing out your retirement savings can help set you up for success later in life. The more you save towards retirement, the better off you'll be financially when you retire, and start early. It helps to accumulate more money because you earn interest on the money you invest. 7. Have a rainy day fund. A rainy day fund is money you save to cover unexpected financial emergencies, such as a family illness, your car breaking down, or sudden changes in income. Non-emergencies are things like holidays, celebrations, and things that can be planned for. It's a good idea to separate emergencies from non-emergencies. It'll make it a lot easier to build up your savings when you're not dipping into your emergency funds for things that don't need paying. Start saving early. The easiest way to build your savings is to start early. Doing so lets you take advantage of the power of compounding. Say you're 20 years old. If you contribute $6,000 to an individual retirement account every year, which is $500 a month for 40 years, your total investment would be $240,000. But because of the power of compounding, your investment would grow to more than $1.37 million, assuming a 7% return. And you'd be a millionaire by age 57, just by saving $500 a month. Develop multiple income streams. You're unlikely to get wealthy by working in just one job. You need many income streams. In a study of self-made millionaires, 65% of them had 3 streams, 45% had 4 streams, and 29% had 5 or more streams. Be smart. Have multiple income streams. Save to invest. Savings should be earning you the best rates possible. The simplest starting point is to contribute to your 401k or pension fund if your employer offers one, and take full advantage of your company's 401k match program, which is essentially free money if your company has one. Stupid people don't subscribe to pension funds, and they miss out on the company's contribution to the pension fund. And of course, the company saves money, but you lose out on the company's contribution. Be smart. Take advantage of the free cash. My free tip: claim as much of the tax you paid back as you can, and then don't spend it. Invest it to pay off debt or invest in shares. Only idiots don't claim back tax rebates. It's free money. Be a saver, investor, and be a millionaire. In the group of millionaires, there are 3 groups. Group 1 is the savers. The key to pursuing the saver investor path is living below your means. But in order to live below your means, you must create a standard of living in which your living costs are 80% or less than your net take-home pay. This means making sacrifices. It might also mean working a second job or having a side business. But ultimately, the saver investor path is available to almost everyone. Of the millionaires are the executives. The second group work for large publicly held corporations. Through hard work, smart office politics, constant self-improvement, and powerful relationship building skills, they rise to the top of the ladder in their respective companies. As executives, they receive higher than normal compensation, which always includes bonuses and stock compensation. We are the entrepreneurs. This group by far accumulated the most wealth, averaging about $7.4 million over an average of 12 years. This was the highest risk and hardest path towards building wealth. In fact, 34% of the self-made millionaire entrepreneurs in the study failed at least once in business, which took a toll on their families and their lives. The upfront investment in time and money was significant. The early part of the journey for the typical entrepreneur is fraught with nothing but uncertainty. They invested most, if not all, of their time, money, and energy in something with no guarantee of success. Being an entrepreneur is hard, but high risk, high return.